Howdy, Jacob here. Today we're looking at Howmet Aerospace in the aerospace and defense industry, 39 billion market cap on 41 billion enterprise value. They provide advanced engineered solutions for the aerospace and transportation industries globally. Founded in 1888. Been around for quite some time here, and we actually see a decline of revenue from 10 years ago. I would bet some money that they made a devastation from 2017 into 2018, and then revenue dropping from COVID. No surprise there. So let's see if there's any big sell-offs in 2018, and we don't actually see. We see a big net um, sell of investments there, but it looks like they've been selling off investments pretty much consistently. Obviously, the net amount changes quite a bit, but since 2016, they've had large net uh, devastations rather than investments. So that's what's been leading to their decline of revenue. But with that said, they have become more efficient, and it's entirely obvious through their operating margin from 2023 greater than their gross margin in 2014. So I don't actually mind that. They make almost half in revenue and they produce even more operating profit. So that is a fantastic sign of a company that's trying to get rid of the trash and keep the gold. They're trying to water the plants and take out the weeds. That's exactly what you want to see. They pay a dividend and it's pretty little compared to their earnings per share. It's a 0.3% yield, so it's pretty little either way. Return on invested capital is growing because, again, they must have sold off some assets, sold off some investments, and they're making more money. So that's a positive sign. Balance sheet shows 610 million cash on hand, 3.5 billion long-term debt, 206 million short-term debt. So let's see what that is in relation to free cash flow. So 3.5 billion, 3.5 billion. They don't quite produce. Well, recently they've produced over 700. So this could be less than 5 years of their free cash flow. But historically, again, things have just changed a lot. So it's probably more like 6 or 7 on an average basis. But again, if they are truly, really improving their um, free cash flow, which I mean, cash from operations is down, but capex is down massively to where they actually are producing good amount of money with about 50 plus percent going to debt, and then a little bit less going towards share repurchases, and then what does that make? 10 to 15% to a dividend. So majority of their cash allocation is going to debt reduction. And so I will be assuming that into the future, saying that, maybe 20 to 30% of capital allocation will be going to debt reduction, leaving only 70, 80% for share repurchases, dividend, acquisitions, reinvestments. So on the revenue growth side, pending they're done with all their sell-offs, I think they should be able to, now that they're hopefully a more efficient company, which that we've seen from the numbers. Hopefully, they're truly efficient, gotten rid of all the trash, all the weeds, and watering the plants. I think that 4% seems fine. I think market average seems fine to me. Maybe just because a lot has changed, I want a 17.5% return. Again, that's just because when you have a long history of consistent data, it's easier to tell when they've kind of sold off like a lot of investments from the last 7 years. So you can see huge sell off, huge sell off, huge sell off, huge sell off, decent net sell off. It is flattening out, but again, we don't have a long history of these massive margins. So I'm gonna take a little bit extra margin of safety for me personally, and then do a decently sized range of margins with repurchasing of shares. 1% is roughly 400 million, and that's enough for me to get 1%. So the dividend, have they increased that in the past? Not, can't really tell. So I'm going to keep that the same. And it's not looking fantastic. We're saying it needs to fall 88% before you get the return we look for here. I mean, I could just be missing something completely. But for me, with what I'm seeing, I mean, if you really understand this business and you are confident they got rid of all the trash and are leading with the most promising portion of the business, then I'm sure they can grow better and have better margins than this. But based on what I'm seeing, I'm not willing to do anything more. Hope you enjoy the video.